Microeconomics for Investors. Chapter 14. Microeconomic Indicators. Section 1. Company KPIs. Company KPIs matter because they translate a business model into measurable evidence. For investors, they help answer a simple question. Is this company actually turning customer demand into durable financial performance? Metrics like growth, margins, and operating efficiency reveal different parts of that story, and each one fills in a missing piece. A company may be growing fast, but if costs are rising even faster, the headline growth number can be misleading. That is why KPIs work best as a set, rather than one at a time. Tracked over several periods, they help you judge whether the business is becoming stronger, weaker, or simply more complicated beneath the surface. Revenue growth rate is one of the first KPIs investors look at because it shows how quickly sales are changing from one period to the next. The formula is current revenue minus prior revenue divided by prior revenue expressed as a percentage. Strong revenue growth can suggest rising demand, successful expansion, better pricing, or market share gains. But top-line growth is only the starting point, not the conclusion. If a company is buying growth through deep discounts or heavy spending, the quality of that growth may be poor. So when you see a high growth rate, the follow-up question should always be whether that growth is efficient and sustainable. Gross profit margin asks how much revenue is left after covering the direct cost of producing or delivering the product or service. The formula is revenue minus cost of goods sold divided by revenue. This is an important clue about pricing power and production efficiency, because it focuses on the economics of the core offering before overhead enters the picture. A higher gross margin can mean the company can charge attractive prices, control input costs well, or deliver efficiently. A falling gross margin often points to cost inflation, competitive pricing pressure, or more discounting. For investors, gross margin helps reveal whether the basic engine of the business is strong. Operating margin goes one step deeper by asking how much revenue remains after both direct costs and operating expenses. It is calculated as operating income divided by revenue, and it reflects whether management is controlling the day-to-day cost structure of the business. This includes overhead items such as selling, general, and administrative expense, as well as research and development where relevant. A company can report a healthy gross margin and still disappoint at the operating level if overhead grows too quickly. When operating margin falls, it often means expenses are expanding faster than sales. If operating margin turns negative, that is usually a sign that the core business model still needs work or is under serious pressure. Not every important KPI comes from a neat formula. Some of the most valuable indicators are structural, and customer concentration risk is a good example. A business may show strong revenue growth and decent margins, yet still be fragile if too much of its sales depend on just a few customers. Losing one major account can create an immediate drop in revenue and possibly in profitability as well. That means headline KPIs can look healthy while the underlying revenue base is unstable. Good analysis always pairs the numbers with business context, especially when the company depends heavily on a small set of relationships. It also helps to sort KPIs by what they are telling you in time. Leading indicators, such as new orders, store traffic, or signups, hint at what may happen next. Lagging indicators, like revenue, net income, and earnings per share, confirm what has already happened. Operational KPIs, including inventory turnover, days sales outstanding, or churn, help explain why results are changing. Used together, these categories connect causes with outcomes. Investors get a much clearer picture when they can see both the early signals and the confirmed results, along with the operating mechanics in between. A practical KPI review follows a disciplined process rather than a random scan of numbers. First, choose metrics that actually fit the business model, because the right KPIs for a retailer will differ from the right KPIs for a software company. Then keep the formulas consistent over time so that changes in the numbers reflect business performance, not changes in measurement. After that, compare the results with the company's own history, with close peers, and with industry averages. The most useful insights often come from mismatches, such as rising revenue paired with falling margins or worsening operations. Those combinations tell you where to investigate further instead of stopping at a surface-level conclusion. Technova gives us a simple example of why investors should look beyond sales growth alone. From 2022 to 2023, revenue rose from $42 million to $50 million, which is roughly 19% growth. On the surface, that looks encouraging and might suggest stronger demand or successful expansion, but gross margin slipped from about 38% to 36%, and operating margin fell from about 19% to 16%. So the company sold more, but kept less profit from each dollar of revenue. That combination often means the business is growing, but not as cleanly or as profitably as before. Reading the Technova trend carefully, the key takeaway is that growth and business health are not the same thing. Rising sales alongside weakening margins suggest that something underneath the surface is deteriorating. The company may be facing higher input costs, heavier discounting to win customers, or rising overhead that is not being absorbed efficiently. Competitive pressure could also be forcing the company to accept lower profitability in order to keep growing. For investors, this is the moment to stop celebrating the top line and start asking sharper questions. Healthy growth is usually supported by stable or improving margins, not declining ones. KPI analysis becomes much more useful when you avoid a few common mistakes. One of the biggest is relying on a single metric, such as revenue growth, and ignoring the rest of the picture. Another is focusing on one quarter in isolation instead of tracking trends over several periods. Comparisons can also go wrong when investors line up companies from very different industries with very different cost structures. It is also risky to assume that growth always signals strength, because weak quality growth can hide deteriorating economics. And finally, even good-looking KPIs can mislead if you overlook issues like concentration risk or poor revenue quality. Section 2. Unit Economics. Unit economics shifts the analysis from the whole company to one basic economic event. That unit might be a single order, one customer, one subscription month, or one transaction, depending on the business. The goal is to test whether the company creates value at the smallest repeatable level. If one sale loses money before fixed costs, then adding more sales usually scales the problem rather than solving it. By contrast, if each unit produces a healthy contribution, growth has a stronger foundation. This is why investors use unit economics to check whether a business really works before getting excited about expansion. Choosing the right unit is crucial because the entire analysis depends on matching the unit to how the company actually earns money. For a retailer, the natural unit may be one item sold. For a SaaS company, it is often one customer per month, since revenue and costs recur over time. A marketplace may focus on one transaction, while a subscription business may use one billing period. If the unit is poorly defined, the numbers become confusing and the conclusions lose meaning. Clear, consistent units make it possible to compare performance over time and judge whether the economics are improving. Most unit economics analysis begins with three core metrics. The first is unit margin, which is revenue minus direct cost for a single unit. The second is contribution margin, which goes further by subtracting broader variable costs tied to that unit, such as payment fees, support, or commissions. The third is payback period, which compares customer acquisition cost with contribution generated per period to show how long it takes to recover the upfront spend. That final step is especially important for investors because timing matters, not just profitability in theory. In general, shorter payback means the business recovers cash faster and has more room for error. To use unit economics well, you need to classify costs carefully. Direct costs are the costs required to produce or deliver the unit itself, such as materials, shipping, or hosting. Variable costs are broader costs that rise as volume rises, including payment processing fees, sales commissions, for customer support, or some forms of marketing. These are different from fixed overhead items like rent or executive salaries, which do not increase one-for-one with each additional unit. The distinction matters because unit economics is trying to isolate what happens when the company adds one more sale or one more customer. If meaningful variable costs are left out, the unit will look healthier than it really is. A practical unit economics review follows a simple sequence. First, define the unit clearly and keep the period consistent. Then calculate average revenue per unit, such as revenue per subscriber per month in a SaaS business. Subtract direct costs to get unit margin, and then subtract variable costs to get contribution margin. After that, compare acquisition cost with contribution per period to estimate payback time. For example, if a customer costs $100 to acquire and contributes $25 per month, the payback period is 4 months. That sequence helps investors move from the basic economics of one unit to the broader question of whether growth is cash efficient. It is important not to confuse strong unit economics with overall company profitability. A business can have healthy contribution from each sale or customer and still lose money because fixed costs are too high. Heavy spending on headquarters, product development, or expansion can overwhelm otherwise good unit performance. The reverse can also happen for a while, where reported company results look acceptable even though the unit economics are weak, perhaps because outside funding or temporary support is masking the problem. Over time, strong businesses usually need both healthy units and controlled fixed costs. Unit economics tells you whether the core transaction works, while net income tells you whether the whole machine works. Consider a meal kit subscription where one weekly box is the unit. If the company earns $60 of revenue per box and the direct cost is $40, the unit margin is $20. Then we subtract variable selling costs, such as a $1.80 processing fee and $5 of marketing allocated per box. That leaves a contribution of $13.20 per box. The key lesson is that the first margin is not the final one. A unit can look attractive before selling costs, but become much less compelling after all meaningful variable costs are included. Once contribution margin is known, investors can connect it to customer acquisition cost. In this meal kit example, each box contributes $13.20 toward recovering CAC, covering fixed costs, and eventually creating profit. If CAC is $200, the payback period is about 2 weeks or just under 4 months if the customer receives 1 box per week. Whether that is good depends on how long customers typically stay. If many subscribers cancel before payback, growth burns cash instead of creating value. So unit economics and retention have to be analyzed together, not separately. The SaaS example shows a business that is viable but not especially comfortable. The customer generates $100 of monthly revenue and about $82.50 of contribution margin, which sounds strong at first. But acquisition cost totals $610, leading to a payback period of roughly 4 months. If average retention is only around 8 months, the company recovers its CAC with very little cushion left over. That means even small setbacks, such as higher churn, lower conversion, or added service costs, could erase the economic gain. For investors, this is the difference between a model that works and a model that works with almost no room for error. The main investor takeaway is that unit economics is powerful, but only if it is handled with discipline. One common mistake is averaging all customers together when different segments behave very differently. Another is leaving out meaningful variable costs, which can make contribution margins look artificially strong. It is also essential not to confuse positive unit margin with net profit for the entire company. Retention and payback speed deserve special attention because even profitable units can destroy value if cash is recovered too slowly. Positive unit economics is an important starting point, but durable business quality requires more than that alone. Section 3. Customer Acquisition Cost. Customer Acquisition Cost, or CAC, measures how much a company spends on average to win one new customer. In simple terms, it asks whether growth is being bought cheaply or expensively. That matters because a business can add customers quickly and still destroy value if each customer costs too much to acquire. For investors, CAC is one of the clearest ways to judge the efficiency of a growth strategy. It turns sales and marketing activity into a comparable economic signal. When paired with other metrics, it helps separate impressive-looking growth from genuinely high-quality growth. A good CAC calculation includes more than ad spend alone. It should capture the full set of costs tied to bringing in customers, including advertising, sales salaries, commissions, marketing software, analytics tools, content, creative work, agencies, promotions, and related overhead. If a company counts only paid ads and ignores the rest, CAC will look lower than reality. That can make customer acquisition appear more efficient than it actually is. Investors should pay close attention to what is included and what is left out. Incomplete CAC is one of the easiest ways for growth economics to look better on paper than in practice. To calculate CAC, start by choosing a consistent period, such as a month or a quarter. Then total the acquisition-related costs incurred during that same period. After that, count only first-time paying customers acquired in that window, not renewals, upgrades, or repeat purchases. Divide total acquisition cost by the number of new customers and you have average CAC. If useful, you can break the number out by channel, because search, social, referrals, and partnerships may have very different economics. The key is matching spending and customer counts to the same time period, so the result means something. It is also important to distinguish between blended CAC and paid CAC. Blended CAC uses all acquisition costs and divides by all new customers, giving a broad picture of total customer acquisition efficiency. Paid CAC is narrower. It uses only paid channel costs and divides by customers acquired through those paid channels. These two numbers answer different questions. Blended CAC helps you understand the overall growth model, while paid CAC helps assess advertising efficiency more directly. Investors should always know which version they are looking at, because the interpretation changes with the definition. CAC becomes far more informative when it is compared with lifetime value, or LTV. CAC tells you the cost to acquire a customer, but LTV estimates the gross profit expected over the customer relationship. If LTV is much larger than CAC, acquisition is usually creating value. A common rule of thumb is an LTV to KPI ratio around 3:1 or better, though that benchmark can vary by business model and industry. Around 1:1 suggests little real economic gain, and below 1:1 usually means value is being destroyed. So CAC alone is a cost number, but CAC paired with LTV becomes a business quality test. CAC should always be interpreted in context, rather than treated as automatically good or bad. A relatively high case may be perfectly acceptable in a business with high margins, strong retention, and fast payback. The same CAC could be dangerous in a low-margin model with weak repeat behavior. That is why investors compare CAC with LTV, contribution margin, and payback speed instead of judging it in isolation. They also watch whether CAC is rising or falling over time and whether different channels or customer segments behave differently. Context turns CAC from a rough cost estimate into a much sharper analytical tool. EgoBox gives us a simple blended CAC example. In March, the company spent $27,000 across Google Ads, Facebook Ads, sales salaries, and marketing software. During the same month, it acquired 450 new subscribers. Dividing 27,000 by 450 gives a blended CAC of $60 per new customer. The arithmetic is straightforward, but the discipline matters. Same period costs, same period new customers. This kind of calculation gives investors a clean starting point for judging whether the company's growth spending is efficient. When EcoBox isolates its paid channels, the picture becomes even more specific. Paid costs total $17,000, and paid channels bring in 300 customers, so paid CAC is $56.67. If customer lifetime value is $240, then the blended LTV to CAC ratio is 4:1 using the $60 blended CAC. That suggests the acquisition economics are healthy. But the sensitivity also matters. If paid CAC rises to $80, the ratio falls to 3:1. The business still works, but the margin of safety becomes thinner. Freshbox shows why acceptable-looking CAC can still be disappointing once LTV is considered. Both blended CAC and paid CAC come out to $120, which may not seem extreme on its own. But with an LTV of only $180, the LTV to CAC ratio is 5:1. That is above break-even, so the company is not obviously losing money on each customer. Still, it falls well short of the common 3:1 benchmark for healthy acquisition economics. For investors, that means growth may be technically working, but not with the durability or efficiency you would want to see. CAC is easy to misread when the underlying inputs are sloppy. One common error is counting only ad spend while ignoring salaries, software, agencies, or other acquisition-related costs. Another is including renewals, upgrades, or upsells in the customer count, even though CAC should focus on genuinely new customers. Timing mistakes also matter, because spending from one period should not be matched against customers from another without a clear reason. Blended averages can hide weak channels, so channel-level detail is often useful. And finally, CX should never be interpreted without LTV, because a cheap customer can still be a bad customer if long-term value is weak. Section 4. Retention and churn. Retention and churn measure whether a company keeps the customers it already has. Retention rate is the share of a starting customer group that remains active at the end of a period, while churn rate is the share that leaves. For the same starting group over the same period, those two numbers add up to 100%. This makes them simple in concept, but very powerful in practice. High retention usually supports steadier, more efficient growth because past acquisition spending continues to generate value. High churn means the business has to keep replacing lost customers just to stand still. Investors care deeply about retention because keeping customers is often cheaper than finding new ones. When churn is high, the company is forced to spend repeatedly on sales and marketing just to refill the customer base. That weakens efficiency and can make even decent unit economics look fragile. Strong retention has the opposite effect. Past acquisition spending keeps paying off over time. It allows customer value to compound instead of resetting every period. In many subscription and recurring revenue businesses, retention is one of the clearest indicators of long-term quality. Retention can be measured in more than one way, and the choice changes the story. Customer retention asks a simple question: how many customers from the starting group stayed? Gross revenue retention focuses on the revenue from that same group, but excludes any expansion from upsells. Net revenue retention goes further by including churn, downgrades, and upsells together. If net retention rises above 100%, it means existing customers are spending more overall, even after losses. That distinction matters because a company can keep many customers but still lose revenue, or lose some customers while growing revenue within the remaining base. To understand retention properly, investors often use cohorts and separate types of churn. A cohort is a group of customers who started at the same time, and cohort analysis tracks what happens to that same group in later periods. This helps reveal whether newer customers are sticking around better or worse than earlier ones. It is also useful to separate voluntary churn, where customers actively cancel, from involuntary churn, where customers are lost because of billing failures or expired cards. Those two forms of churn imply different underlying problems. One points more toward product value, while the other may point toward operational friction. A simple retention calculation starts with the customers who were active at the beginning of the period. Choose a period that fits the business, such as a month, quarter, or year. Then count how many of that same starting group remain active at the end. Retention equals remaining customers divided by starting customers, and churn is 100% minus retention. The important discipline is to ignore new customers acquired during the period when measuring this particular rate. Retention is about how well the business keeps the original group, not how much new growth was added on top. Suppose a company begins January with 1,000 customers and 940 of those same customers are still active at month end. Retention is 940 divided by 1,000, which gives 94%. Churn is the remaining 6%. This example is simple, but it highlights a common source of confusion. If the company also added new customers during January, those new signups do not belong in the retention calculation for the original January base. The purpose is to measure how well the starting cohort was preserved. Consider a fitness app that starts with a January cohort of 5,000 subscribers, each paying $10 per month. During the month, 150 cancel voluntarily and 30 are lost because of payment issues, leaving 4,820 from the original cohort. Customer retention is therefore 4,820 from the original cohort. Customer retention is therefore 4,820 divided by 5,000 zeros, 4%. Because every subscriber is on the same $10 plan, gross monthly revenue retention is also 96. 4% with $200 of the original $300 of monthly recurring revenue preserved. The 400 new subscribers who joined during the month are good for growth, but they are not part of this cohort retention calculation. That separation keeps the analysis clean. Net retention adds another layer by including expansion within the existing cohort. If 50 of the remaining customers upgrade from $10 plans to $20 plans, the company gains an extra $500 of monthly recurring revenue from that same starting group. Gross retained revenue was $48,200, and adding $500 of expansion brings net retained revenue to $48,700. Dividing that by the original $50,000 gives net retention of 97.4%. Gross retention tells you how well the base was preserved before expansion. Net retention tells you what happened after considering churn, downgrades, and upsells together. In the July practice check, the company starts with 800 active customers. It loses 48 through cancellations and 12 through payment failures for total losses of 60 customers. Gross churn is 60 divided by 800, or 75%, which means gross retention is 92. 5%, which means gross retention is 92. That leaves 740 customers from the original base, and if each pays $50, gross monthly revenue retained is $37,500. The 100 new customers added during the month are excluded from this retention analysis because they were not part of the starting cohort. If some of the retained customers upgraded, then net retention could rise above 100%. Retention metrics are valuable, but they are easy to misuse. One common mistake is counting new customers in the retention base, which makes results look stronger than they are. Another is relying only on total customer growth, since a business can grow while still churning heavily underneath. It is also helpful to track involuntary churn separately from active cancellations because the remedies are different. Investors should be careful not to confuse customer retention with revenue retention, since those can tell very different stories. And comparisons across segments should be made thoughtfully because enterprise customers, small businesses, monthly users, and annual subscribers may have very different retention patterns. Section 5. Margin Analysis. Margin analysis matters because it shows how much profit a company keeps from each dollar of sales. Using percentages instead of raw profit makes it much easier to compare companies of different sizes and to compare the same company across time. A business with lower revenue can still be more profitable in a relative sense if it keeps a larger share of each sales dollar. Margins also reveal changes that sales growth can hide. Revenue may be rising while profitability quality is getting worse. For investors, margins are one of the clearest ways to judge whether growth is actually creating value. There are 3 main margins, and each answers a different question. Gross margin focuses on product economics by asking how much remains after direct costs. Operating margin looks at business efficiency by including overhead and operating expenses. Net margin goes all the way to the bottom line and shows what is left for shareholders after interest, taxes, and other major costs. Looking at only one of these can miss where pressure really begins. Read together, they help investors identify whether weakness starts in the offering itself, in the cost structure, or below the operating line. Gross margin isolates the economics of the core offering before overhead, financing, and taxes are considered. The formula is gross profit divided by revenue, and gross profit is revenue minus cost of goods sold. If a company generates $100 of revenue and $60 of direct cost, gross profit is $40 and gross margin is 40%. Higher gross margin can suggest pricing power, efficient production, or a favorable product mix. Falling gross margin often points to rising input costs, heavier discounting, or stronger competition. Because it focuses on direct economics, gross margin is often the first place where business pressure becomes visible. Operating margin asks how efficiently the company converts sales into profit after covering both direct costs and operating expenses. It is calculated as operating income divided by revenue, where operating income equals gross profit minus expenses such as SG&A, research and development, and depreciation. This means operating margin reflects management's control over the broader cost structure, not just the product itself. 2 companies can have the same gross margin and still have very different operating performance if one carries much heavier overhead. That is why strong gross margin alone is not enough. Investors want to see whether the company can hold on to that gross profit after running the business. Net margin is the broadest profitability measure because it captures what remains after all major costs are deducted. The formula is net income divided by revenue, and it includes not only operating costs, but also interest, taxes, and other below-the-line items. This makes net margin highly important, but also more affected by financing choices and tax structure than the other margins. Two companies with similar operating results can end up with different net margins if one carries more debt or faces a different tax burden. That is why net margin is best interpreted alongside gross and operating margin. On its own, it tells you the outcome, but not always the source of that outcome. The real power of margin analysis comes from reading the margins together. If gross margin is high but operating margin is weak, the likely issue is overhead rather than product economics. If operating margin looks healthy but net margin is much lower, debt costs or taxes may be taking a large share of profits. If net margin improves while gross margin deteriorates, the gain may come from something temporary rather than from a stronger core business. The gaps between the margins are often just as informative as the margins themselves. For investors, those spreads act like clues that show where pressure or improvement is entering the income statement. Margin analysis becomes much more powerful when you look at trends instead of snapshots. A single quarter can be distorted by seasonality, one-time items, or temporary cost swings. Over several periods, you can see whether gross margin improves with scale, whether operating leverage is appearing, and whether profitability is becoming more stable. This is especially important for younger companies, which may have negative operating margins early on, even if the business model is improving. Direction and consistency often matter more than one isolated result. Investors should always ask whether the margin story is strengthening over time or just fluctuating noisily. To calculate margins, start from the income statement and work downward in order. Gather revenue, cost of goods sold, operating expenses, and net income. Subtract COGS from revenue to get gross profit, then divide by revenue for gross margin. Subtract operating expenses from gross profit to get operating income, then divide by revenue for operating margin. Finally, use net income over revenue to calculate net margin. The process is simple, but consistent classification matters a great deal because moving costs between costs and operating expense can distort comparisons across periods. The software company example shows how the three margins fit together. With revenue of $10 million and COI of $3 million, gross profit is $7 million, so gross margin is 70%. After operating expenses, operating profit is $2.5 million, which gives an operating margin of 25%. After interest and taxes, net profit is $2.5 million, which gives an operating margin of 25%. After interest and taxes, net profit is $15 million for a net margin of 5%. That pattern suggests strong product economics and solid profitability after overhead. The relatively modest drop from operating margin to net margin also suggests that financing and tax burdens are not overwhelming the business. When all three margins decline together, it often signals pressure beginning in the core business and flowing through the rest of the income statement. Imagine gross margin falling from 70% to 65%, operating margin dropping from 25% to 15%, and net margin declining from 5% to 5%. The first warning appears at the gross level, where each sale becomes less profitable. That weaker base then leaves less room to absorb operating expenses, and eventually less reaches the bottom line. Possible causes include rising input costs, lower pricing, or stronger competition. The pattern matters because it suggests the problem is structural rather than just financial or tax-related. The retailer trend offers a good example of why margin analysis should sit beside revenue growth. From year 1 to year 2, revenue increases, but gross margin falls from 36.0% to 34%. 6% operating margin falls from 12.0% to 10.6%, and net margin falls from 12.0% to 10.6%, and net margin falls from 9.0% to 7.8%. The largest drop is in net margin, down 2 percentage points. That tells a more cautious story than rising sales alone would suggest. The company is growing, but each sales dollar is producing less profit at every level. For investors, That raises the risk of growth without improving profitability. Margin analysis is powerful, but there are several pitfalls to avoid. One is relying on net margin alone, which can hide whether weakness began in product economics or operating discipline. Another is failing to adjust for one-time items, such as an asset sale or tax benefit, that can temporarily inflate reported profitability. Comparisons should also be made with close industry peers because margin structures vary widely across sectors. Investors should watch for cost reclassification as well, since moving expenses between categories can make margin trends look better or worse than they really are. The best practice is to read gross operating and net margins together over time and in the right competitive context.